What is the price-to-book ratio? The price-to-book ratio, often shortened to PB ratio, is a way of comparing a company's stock market value with the value of its assets on paper. In plain English, it asks, how much are investors paying for each pound of net assets the company owns? Book value is the accounting value of a company's assets, like buildings, equipment, and cash, minus its debts. To find the PB ratio, you divide the company's share price by its book value per share. The formula looks like this. PB ratio equals share price divided by book value divided by number of shares. Why does it matter? This ratio matters because it gives investors a sense of whether a stock might be underpriced or overpriced relative to what the company actually owns. A low PB ratio, below 1 for example, can suggest that the market values the company at less than its assets are worth on paper. That might hint at a bargain, although it could also signal that the company is struggling. A higher PB ratio often means investors are willing to pay more because they expect the company to grow, or because its intangible assets, such as brand reputation or intellectual property, aren't fully reflected in the book value. Many value investors, such as those inspired by Warren Buffett, have used PB ratios as a starting point when hunting for undervalued companies. Here's a simple example. Imagine a small publishing company. It owns offices, printing equipment, and cash worth £5 million. After subtracting debts of £1 million, its book value is £4 million. If there are 1 million shares in circulation, the book value per share is £4. Now suppose the shares trade on the stock market for £6 each. Divide £6 by £4, and you get a price-to-book ratio of 1.5. This means investors are paying 50% more than the company's book value because they believe the publisher has strong future prospects, perhaps thanks to a popular new author or a strong brand. You can think of it like buying a house. The book value is what the paperwork or mortgage statement says the house is worth. The market price is what people are actually willing to pay for it in today's housing market. If the market price is much higher than the book value, it means buyers see something special. Maybe the area is up and coming or the design is unique. If it's lower, it might be because the house needs work or isn't in high demand. What else should you know? The price-to-book ratio has its limits. It works best for companies with lots of tangible assets, like banks, insurers, or manufacturers, where book value is a good reflection of real value. For technology firms or companies built around ideas and brand reputation, the book value may underestimate what the business is truly worth, since things like software, patents, or customer loyalty don't always appear fully on the balance sheet. It's also important to understand that book value depends on accounting rules, which means assets may be recorded at historical cost rather than their current market value. A company's land, for example, might be worth far more today than when it was purchased decades ago. And while a low PB ratio can look attractive, it's not always a sign of a hidden bargain. Sometimes it's a red flag. Perhaps the company is losing money or its assets aren't easy to sell in practice. This is why investors rarely look at the PB ratio on its own. Instead, they use it alongside other measures, like the price-to-earnings ratio or return on equity, to build a fuller picture of a company's health and prospects. To sum it all up, the price-to-book ratio compares a company's share price with the value of its net assets. It can highlight whether a stock looks cheap or expensive, but it has limits, especially for businesses built on intangibles. Like many financial ratios, it's most useful when seen as one piece of a bigger puzzle. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.